Right now, while most retail investors are dumping their silver after a brutal pullback, the biggest financial institutions on the planet are quietly doing the exact opposite. They are buying, not small amounts, not test positions. They are accumulating silver at a pace that has not been seen in years, and almost nobody watching the news is talking about it. If that sounds strange to you, it should, because everything you have been told about this recent silver sell-off is only half the story. Just weeks ago, silver was trading near $67 an ounce, a level that stunned even seasoned traders. Then came the pullback. Prices dropped nearly 10% in a single month, and headlines started screaming that the silver rally was over. Retail investors panicked. Coin shops saw a wave of people selling back their holdings. Online forums filled with people saying they had missed their chance. But here is the detail almost nobody caught. While the public was selling into fear, institutional buyers were doing the opposite, treating that same drop as an opportunity most people would only recognize in hindsight. Before we go further, if you are new to this channel, hit that subscribe button and tap the like button right now, because what you are about to learn about how smart money actually moves is going to change the way you look at every market dip for the rest of your life. So why would professional money buy into weakness while everyone else runs for the exits? To understand that, you have to understand what silver actually is. Most people think of silver as just a cheaper version of gold, something you buy when you cannot afford the real thing. That assumption is wrong, and it is costing people real money. Silver lives a double life. It is a monetary metal, the kind investors turn to when they distrust currencies or fear inflation. But it is also an industrial metal, and this is the part that changes everything. Something close to 60% of all the silver demand in the world does not come from investors at all. It comes from factories. It comes from solar panel manufacturers. It comes from electronics companies building the devices you are using to watch this video right now. Here is where things get interesting. That industrial demand has been exploding. Solar panel installations around the world have surged, and every single one of those panels requires silver paste to conduct electricity efficiently. Electric vehicles need it. Advanced electronics need it. Even next-generation medical devices depend on it. So while retail traders were watching a price chart and reacting emotionally to a short-term drop, the underlying physical demand for actual silver never stopped climbing. But that alone would not explain why institutions are moving in aggressively right now. There is something bigger happening beneath the surface, and it has to do with the relationship between silver and gold. For decades, traders have used something called the gold-to-silver ratio to measure whether silver is cheap or expensive compared to gold. Historically, that ratio hovers somewhere around 50 to 1, meaning it takes about 50 ounces of silver to equal the value of 1 ounce of gold. At the peak of global uncertainty back in 2020, during the depths of a worldwide crisis, that ratio spiked to nearly 125, meaning silver became historically undervalued compared to gold. Right now, even after silver's massive run higher, that ratio still sits around 65 to 1. To institutional analysts, that is not a warning sign. That is a signal that silver still has room to close the gap. This is where the situation becomes much bigger than a simple price chart. Major financial institutions have started publishing forecasts that would have sounded absurd just 2 years ago. Some of the largest research desks on Wall Street are now projecting silver could average somewhere in the $80 range before the end of this year, with longer-term projections stretching even higher by the end of the decade. When institutions with billions of dollars under management start putting numbers like that in writing, it tells you something about where their capital is quietly flowing. Now here is the detail most people miss. This is not happening in isolation. It is happening against a backdrop of currency concerns, shifting interest rate expectations, and global instability that keeps pushing large pools of capital toward hard assets. When recent labor market data came in weaker than expected, expectations for future interest rate hikes dropped sharply. Lower rates make it cheaper to hold assets like silver that do not pay interest, and that alone was enough to send the metal surging again within days. The pattern is becoming impossible to ignore. Every time uncertainty creeps back into the financial system, silver responds. At first glance, this seems simple. Buy silver, wait, profit. But it is not that simple, and if you stop watching now, you will miss the part that actually separates smart money from everyone else. Institutional investors are not just buying silver and hoping for the best. They are positioning around a structural imbalance that retail investors rarely think about, which is supply. Unlike gold, most of the world's silver is not mined on its own. It comes as a byproduct of mining other metals like copper, zinc, and lead. That means silver producers cannot simply ramp up production just because prices rise. If a mining company is primarily digging for copper, they cannot suddenly decide to prioritize silver output, even if silver prices triple. This creates a supply system that struggles to respond quickly to rising demand, and that mismatch has been building for years. At the same time, industrial demand keeps climbing every single year, driven by the global push toward renewable energy and advanced electronics. So you have a metal where demand is structurally rising, supply is structurally rigid, and investment demand is now accelerating on top of that. That combination is exactly the kind of setup that professional traders look for, and it is exactly why some of the world's largest asset managers have been increasing their exposure even during short-term price weakness. There is another layer to this that rarely gets mentioned in mainstream coverage. Central banks around the world have spent the past several years quietly diversifying their reserves away from a single dominant currency. Most of that attention goes to gold, and rightfully so, since gold remains the primary reserve asset central banks accumulate. But the same underlying motivation, protecting national wealth against currency devaluation and geopolitical shocks, is spilling over into how large institutional funds think about silver as well. When a fund manager overseeing billions of dollars starts asking whether the dollar's purchasing power will hold steady over the next decade, hard assets across the board start looking more attractive, and silver, trading at a fraction of gold's price per ounce, becomes an efficient way to gain that same protective exposure at scale. That alone would be important, but something else is happening that raises the stakes even further. Trade policy uncertainty has repeatedly entered the silver conversation over the past year. At different points, the possibility of new tariffs on imported metals has created what traders call physical tightness, meaning silver bars and coins become harder to source in certain markets because supply gets diverted or held back in anticipation of policy changes. Every time this kind of tightness has appeared, it has added fuel to already rising prices. Analysts who track this closely say the mere possibility of renewed tariff action remains one of the biggest wildcards that could send silver sharply higher again with very little warning. Let's talk for a second about what this means beyond just prices on a screen, because this is bigger than any single investor's portfolio. When institutions position heavily into a metal this central to global manufacturing, it tells you something about how they view the broader economy. It suggests deep concern about currency stability, persistent inflation risk, and a genuine belief that the transition to renewable energy is not slowing down anytime soon. In other words, silver has become a bet on the next decade of the global economy, not just a short-term trade. If you are finding this breakdown useful, drop a comment below and let me know what you think smart money is really preparing for, because the answer might surprise you, and I read every single comment on this channel. Now here is where the bigger picture comes together. Individual investors tend to react to headlines. They see a 9% monthly drop and they panic sell. They see a scary-sounding news segment about volatility and they assume the opportunity is gone. But institutions do not operate on headlines. They operate on structural analysis, spanning years, sometimes decades. When they see a metal with rising industrial demand, constrained supply, a historically wide valuation gap against gold, and increasing macroeconomic uncertainty all converging at the same time, a short-term price dip does not scare them away. It draws them in. This is not to say silver is guaranteed to keep climbing in a straight line. Analysts are clear that volatility remains part of silver's nature, and pullbacks like the one we just witnessed are likely to happen again. Silver has always moved harder in both directions than gold, and that is not going to change. Financial advisors who work with everyday investors consistently point out that silver should represent only a modest slice of a well-balanced portfolio, precisely because of these sharp swings. But understanding why professional money treats these dips differently than retail investors do is the entire key to understanding this market, and it is a lesson that applies far beyond precious metals alone. So here is the bigger picture most people are still missing. This is not simply a story about a shiny metal going up in price. It is a story about the collision of industrial necessity and monetary anxiety happening at the exact same time in history. Solar energy is not slowing down. Electronics are not slowing down. Global currency concerns are not fading away. And silver sits directly at the intersection of all three forces, structurally undersupplied and increasingly demanded by both factories and investors simultaneously. That is why, while everyday investors were rattled by a routine pullback and rushed to sell, the world's largest financial institutions saw a familiar pattern playing out, a pattern they have seen before, right before some of the biggest moves in this metal's history. So here is the question worth sitting with. If the smartest money in the world is treating fear as opportunity, what does that tell you about the difference between how professionals think and how the crowd reacts? Drop your answer in the comments because this conversation is just getting started and I want to hear where you stand. If this video opened your eyes to what is really happening behind the silver market, do not keep it to yourself. Share it with someone who has been sitting on the sidelines wondering whether they missed their window. Hit like if you made it this far, subscribe if you want to keep seeing the stories the mainstream financial media is not covering, and I will see you in the next one, right here on Gold and Silver Intelligence.